Net Wealth Investments Limited is licensed to provide general advice. Our podcasts are not tailored to any one financial situation and may contain views of our presenters which may not align with Net Wealth's. The guests, organisation and Net Wealth have an arrangement for their financial products to be available for investment through the Net Wealth platforms, and Net Wealth may receive fees from the guest. More information about Net Wealth can be found on our website, including our financial services guide and disclosure documents. Please seek professional advice before acting.
Welcome to the Net Wealth Portfolio Construction Podcast, brought to you by the Net Wealth Investment Research Team. In this podcast series, we pick the brains of key wealth management professionals to uncover opportunities and challenges for investors on a diverse range of topics. We hope you enjoy their unique perspectives.
Welcome to the Net Wealth Portfolio Construction Podcast series. My name is Paul O'Connor and I'm the Head of Investment Management and Research. Today we welcome Justin Picker from CBRE Investment Management, who is the leader of the listed Asia Pacific Real Estate Research Team and is responsible for the oversight of the firm's Sydney office. CBRE are the appointed manager of the UBS Property Securities Fund, and Justin is the portfolio manager. CBRE is one of the world's largest real asset investment managers with US $124 billion in assets under management as of 31 March 2021. CBRE Investment Management is 100% owned by the CBRE Group, a Fortune 150 company listed on the New York Stock Exchange. CBRE is a global, fully integrated commercial real estate services organisation with over 100,000 employees in more than 100 countries. The business is headquartered in Radnor, Pennsylvania, USA, and the firm employs over 60 professionals, including an investment team of 29 located in 5 offices around the world. CBRE's listed real assets investment management business and its predecessors have been managing investments on behalf of retail and institutional clients since 1984. UBS Asset Management Australia Limited is the responsible entity for the fund and is a subsidiary of UBS AG and is the parent company of the UBS Group, whose other main businesses include wealth management and investment banking. UBS is an active manager with a varied range of capabilities across equities and fixed income. And as of 30 June 2020, UBS Asset Management Australia managed $47 billion in assets under management. Justin Picker joined CBRE's predecessor firm in 2010, and prior to that, Justin worked in various research and analyst positions at ING Investment Management and the Commonwealth Bank of Australia. He has over 24 years of real estate industry experience and earned a Masters of Applied Finance from the University of Melbourne and a Bachelor of Business from Swinburne University. Justin is a member of the Chartered Accountants Australia and New Zealand and serves as a member of the Asia Regional Advisory Committee for the FTSE EPRA Nareit Global Real Estate Index. UBS has a long-established presence in the Australian funds management market and have 6 funds on the Netwealth Super and IDPS investment menus across fixed income, equities, property and infrastructure. The Australian listed property market is one of the oldest REIT markets globally, dating back to 1971, and is considered mature when compared to other offshore listed REIT markets. Both Australian retail and institutional investors have historically allocated to AREITs as an asset class due to the ability to gain exposure to high-quality investment-grade property and the liquidity also offered by the sector. The asset class provides exposure to a wide range of properties, including industrial, office, retail, diversified, and other properties such as healthcare, aged care, and hotels. The outbreak of COVID in March 2020 resulted in a significant sell-off in the AREIT market, aligned with the broader equities market sell-off. But the AREIT sector bounced back, providing strong returns in April and May last year, and ended the 2020 calendar year with only slightly negative returns. In the current financial year, the AREIT index has returned in excess of 10%, that has surprised many skeptics due to the impact COVID continues to have on the global economy. Whilst the returns have been sound, there are many issues for property investors to consider, including challenges like the office sector is facing, given the structural change to staff working from home, and what that means for the broader office sector. Notably, there's been significant variation in performance between the sectors, with the retail sector remaining subdued, which indicates there's good opportunity still for active management to add value. However, strong growth opportunities remain for other subsectors of the AREIT market, such as industrial property, that is continuing to benefit from the changing consumer behaviours, including online shopping and limited land supply, and the growing need for aged care and health facilities. So I'll certainly be interested in Justin's views on both the headwinds and the tailwinds across the whole of the AREIT sector. Also, with the recent rise in inflation and debate as to whether this recent rise is either transitory or structural, I'll be interested in Justin's views on the level of gearing across the asset class. Perhaps to start with, Justin, can you provide the audience with some background how you ended up specialising in listed property?
Thanks, Paul. I actually started my professional career outside of property. I grew up in Melbourne, and after secondary school, I undertook a degree majoring in accounting. I liked numbers and felt accounting was a logical path to pursue. Early in my career, I was lucky enough to land an accounting role with National Mutual's property development subsidiary at the time. From there, a few things clicked for me. First, I realised I didn't enjoy accounting as much as I would have hoped. And secondly, I realised property was a pretty interesting asset class that I began to build a passion for while working in the accounting role. I've been fortunate enough to have some great mentors in my career, and one of those mentors tapped me on the shoulder one day and suggested I should try my hand at property rather than accounting. In 1999, while at National Mutual, I transferred into a property analyst role. This is really how I segued from accounting to property. Following that, in 2001, I moved into a listed property analyst role, joining Commonwealth Bank and later ING Investment Management. This really began my journey specialising in listed property. I'd found my passion in listed property and haven't really looked back since.
I'm glad to hear there, Justin. I guess that is the aim for all of us in a career there, to actually find a passion that we really enjoy getting up and going to work for daily there. So good to hear. Moving into the questions now for today's podcast, the volatility in listed equities markets post the outbreak of COVID was significant. So can you provide some insights into how the property subsectors performed, and namely industrial, office, retail, and the other sectors?
I can, Paul. The AREIT sector was down 35% in the month of March 2020 as COVID fears sent equity markets into freefall. It was actually one of the worst single months of performances for REITs since the inception of the AREIT index. On a relative basis, AREITs even battled versus other listed asset classes. AREITs underperformed local equity markets by over 14% in the month. And they also underperformed global REITs markets by over 17% in the month of March as well. Looking at how the various AREIT subsectors fared, on a relative basis, the more resilient sectors fared better, as you'd expect, whilst the more economically sensitive sectors that were exposed to potential significant demand destruction from the COVID shock were down more. The majority of REITs dropped guidance during the period, citing uncertainties around the economic impact of COVID. The retail and office REITs were the major underperformers, with groups like Scentre Group and Vicinity Centres down more than 50% in the month, while Centuria Office was down as much as 46%. Defensive, stable, bond-like REITs with quality covenants and steady rent rolls, such as Bunnings, Waypoint, and even Charter Hall Long WALE REIT, were down less than 20%. Industrial logistics REITs, such as Goodman and Centuria Industrial, also fared better than most. They were down between 20 to 30% in the month, given their solid balance sheets and significant exposure to the growth in e-commerce and online sales, which was a clear winner before COVID and has really only strengthened during COVID.
So I guess the biggest focus has been on the office market due to the empty CBD office buildings in both Melbourne and Sydney that we've seen. So what has been the impact on vacancy rates and rental yields? And did the market oversell this sector, which is sort of, I guess, usually the case during periods of significant market sell-offs?
Yeah, it was definitely the case this time as well. And just looking at the direct market, CBD office market vacancies have risen significantly with the onset of COVID, and sublease vacancies have hit new record highs for a period and rents have declined. These market conditions have pushed tenant incentives to levels that have not been seen for many, many years, and in some markets, and then landlords have acted to mitigate a weakening demand supply backdrop. Rising vacancies, softer achievable rents, and adjusted occupier sentiment. Vacancy rates in Melbourne and Sydney CBDs have risen from 2 to 3% levels immediately pre-COVID to above 9% today. This is also above the long-term average vacancy levels, which are closer to 6 to 7%. Looking forward, we expect vacancy to remain elevated, above historical averages for at least the next few years. We're experiencing softer effective rental conditions in 2021. This is on the back of weaker tenant demand. Net effective rents in Melbourne and Sydney CBDs are down around about 12% in the past 12 months and nearly 20% from pre-COVID rental levels. Many tenants continue to contemplate reducing their office footprints. Based on CBRE's recent occupier survey, more than 50% of respondents have suggested they will consider reducing office space over the next 3 years. Looking at rental yields before incentives, these yields continue to track in the mid 4% range and are holding relatively steady at pre-COVID levels across both the Melbourne and Sydney CBDs, albeit incentives have continued to rise in most markets, particularly in Melbourne, where they are now close to 40%. Versus 27% immediately prior to COVID. We believe higher incentives will be sustained, at least for the near term, given the combination of higher supply in some markets, increase in flexible working, and elevated sublease vacancy versus pre-COVID levels. Across Australia, capital values have been surprisingly resilient. They've really only fallen around about 1% in the last 12 months. And frankly, most of that fall has been in the secondary asset class of offices, which are down also around about 1%. From a listed market standpoint, unsurprisingly, office REITs underperformed in 2020, and some were down greater than 15%. And as you suggest, have rebounded in 2021. The listed market has taken the view that office is a reopening trade. Economic growth is ultimately improving, and with COVID eventually behind us, this will be positive for office demand. Also, office transaction evidence has been better than expected through the pandemic. Office stocks continue to trade at 5 to 10% discounts to direct market values. Our proprietary NAVs are higher year to date, and direct transaction evidence suggests that assets are trading at book value or better. This is being driven by ultra-low interest rates, the continued search for yield, and lower return expectations.
Justin, what do you believe is the future of the office sector and what's the AREIT market telling us? And what sort of insights can you share from CBRE's fundamental analysis of the sector?
We believe offices will continue to be an important asset for the future, but prospects for businesses taking 10 to 15% less space in future is a real possibility. We expect a permanent increase in working from home will result in a cumulative net decline in office demand, which is negatively impacting fundamentals and lowering expectations for rental growth. That being said, people and businesses have a strong desire to be together, to collaborate, to build culture, and support team productivity, learning, and development. In future, the office will be considered more than just a physical space, but rather a platform for professional, business, and personal development. A recent Australian CBRE Future of Office survey suggested that over 70% of senior business leaders have a desire to bring employees back to the office, but at the same time, they are willing to offer a greater degree of flexibility and choice. Over 50% of respondents plan to implement policies allowing office-based working with the option of working from home. The adoption of this hybrid working arrangements will require companies to enhance their workplaces. They'll need to deliver the types of seamless and engaging experiences that remote working cannot. Given the demands of office of the future, we expect to see a clear polarization of demand from occupiers and investors. Less quantity and more quality. We believe there will be continued bifurcation between the winners: modern, flexible, and environmentally friendly office buildings versus older vintage commodity-style office buildings.
So, if you're correct there, Justin, the businesses are typically taking 10 to 15% less space. What does that mean for current valuations of the office sector? Are they cheap? Are they expensive?
Valuations are actually relatively cheap at the moment versus direct market values at the moment, Paul. The listed sector is trading at about a 5 to 10% discount to direct real estate asset values. And from a direct office real estate perspective, values have actually surprised us on the upside, with strong capital demand continuing in the space.
Yeah, interesting. So striking me as potentially some investment opportunity there, Justin. What AREIT sectors have been the biggest beneficiaries of the changing economy over the last 12 months, and what trends have been accelerated that were already in place beforehand?
I would point out funds management platforms, residential, industrial logistics, emerging and alternative asset classes, which are becoming more mainstream, and parts of retail, namely large format retail and non-discretionary retail, as the major AREIT beneficiaries of a changing economy over the past 12 months. The industrial logistics sector has been a clear beneficiary, of the growth in e-commerce and online sales. While this is a clear structural tailwind prior to COVID, it has only accelerated as a result of COVID. The e-commerce market in Australia has increased 105% from 2015 to 2020, now accounts for over 13% of total retail trade. COVID has been a clear catalyst for the acceleration of this trend of online sales, with the online penetration rate jumping from 9 to 13% over the course of 2020 alone. Australia still lags behind other major countries and behind global averages of 22% for online sales. Therefore, there is still great scope for further expansion in this sector. CBRE forecasts the penetration rate of online sales to reach, if not exceed, 20% by 2025. REITs with sought-after industrial logistics properties are benefiting from strong fundamentals, with a step change in occupier demand and low supply in some key markets, resulting in capital and rental value uplifts for the REITs. Capital values have been particularly strong, with most of the industrial REIT portfolios recording strong cap rate compression of greater than 50 basis points and value increases of close to 20% over the past 12 months.
Before we bring you the second part of this chat, a little bit about who we are. Netwealth is an ASX-listed company established to help Australians take control of their financial futures. With a wide range of super and investment accounts, a huge variety of investment options and market-leading online tools, we can help you manage your wealth your way. Partner with us to see wealth differently and discover a brighter future. Visit the Netwealth website to learn more and get the PDS, which you should read before making a decision. Products issued by Netwealth Investments Limited.
So, investing in beds and sheds has been a positive thematic and a focus for many real estate investors, including CBRE. What's the AREIT market telling us about logistics and residential currently?
The industrial logistics names have outperformed. Both Goodman and Centuria Industrial are both up over 20% year to date. We're also seeing the market show a preparedness to pay higher multiples for groups that can add value to assets through either development or repositioning for themselves or third parties. We believe the run in industrial logistics can continue in public markets over the medium term. Physical occupier demand is high, land is scarce, supply is generally in check, and earnings growth is healthy. This is supporting higher values. Our NAVs are higher, typically mid to high single digit year to date. Turning to the resi-related REITs, their resi business segments have performed very well over the past 12 months. These stocks are showing better sales activity driven by ultra-low interest rates, heightened savings rates, improving employment conditions, and good demand-supply conditions.
I've noticed, Justin, that many retail centres have been transforming in recent years by, broadening beyond the traditional retail shops by including, things such as dining and entertainment and healthcare. So, who have been the winners and losers in this sector?
Retail sector outlook has improved for the most part in 2021 versus 2020, driven by the reopening of economies, better consumer confidence, and deeply discounted listed property valuations. Investor demand has also improved, particularly in the large format retail and non-discretionary retail areas. And this is where we are focusing our fund's retail exposures. While retail stocks overall have underperformed the AREIT index in 2021, some retail markets and subsectors have performed better than others. Discretionary retail is continuing to suffer from COVID disruption to business activity. They also continue to face structural headwinds from the growth in e-commerce, just causing elevated downtimes and pressures on remixing, particularly too much fashion, high maintenance capex, and over-renting. In a nutshell, the long-term structural challenges posed by e-commerce have combined with the cyclical shock caused by the pandemic. And so falling capital values over the past years and deteriorating effective rents are widespread across the market. Turning to non-discretionary retail, fundamentals have held up better. The asset class is demonstrating income resilience during COVID and has benefited from increased sales and less structural risks, given many of the tenants' services are daily needs and essential services based.
You mentioned earlier, Justin, that alternatives are becoming more mainstream. Where are you finding the opportunities in the alternative real estate asset class, and what lessons have you learnt from being part of a global CBRE team that actively manages REIT portfolios across the world and can provide you with some insights about trends and themes going on in other markets as a result?
Yeah, emerging and alternative sectors, which are typically uncorrelated to other asset classes, are becoming more mainstream, particularly with the headwinds facing many of the traditional commercial real estate asset classes, office and discretionary retail, for example. And pricing in industrial is becoming very rich. These alternative sectors include childcare, healthcare, land lease communities, build to rent, storage, service stations, and even the agricultural sector. Historically, these sectors have traded at wide yield premiums to traditional real estate. But COVID has illustrated the resilience of these asset classes through times of economic uncertainty. Public markets globally benefit from significant exposure to alternative sectors, particularly the US REIT market, which has over 50% weighting to alternative sectors. The Australian REIT market has been slower to move into alternative real estate relative to the US, with close to 10% and growing weighting today. There are listed opportunities in Australia to get exposure to most of these niche sectors, but a percentage of the AREIT index is relatively small. So it requires an active manager to be able to allocate more to these themes. We think the agricultural sector is a great inflation hedge with rising demand for commodities. Specialist managers are showing an ability to improve the productivity of farmland for many different uses, including cattle, cropping, and plantations, for example. When done well, this can create significant value for shareholders. The childcare sector benefits from increased demand, a function of greater urban density and population growth. Government and community recognise the importance of daycare, additional education and support ahead of primary school, and the positive impact it has on increased workforce participation, particularly from females. The sector also enjoys strong government support in the form of subsidies, as seen through COVID. when it was considered to be an essential service. Looking at land lease community sector, it has been a beneficiary of positive demographic trends and the need for affordable over 55s retirement accommodation. The strength and liquidity of the residential market is also providing an additional tailwind as retirees are able to sell their homes faster, facilitating the move to land lease communities. Income from owners in this asset class is underpinned by government pensions. It's very high quality and low risk income, and we've seen no defaults during the COVID.
So we are in times of rapid change, and what are the key themes and ideas you're thinking about and focused on in your Australian portfolio? And what about your CBRE colleagues in the US? What are the key themes and ideas they're considering in a US context, and how does that help your thinking and form your views?
In Australia, we prefer many of the themes we've already discussed, including non-discretionary retail, residential, funds management platforms, and alternative sectors such as land lease communities, childcare, and agriculture. Non-discretionary retail is showing strong rental income resilience. It's enjoying high cash collection through COVID, has low e-commerce impact, and offers affordable rents to tenants. Investor appetite is strong, and direct asset values are continuing to rise in this sector. Emerging and alternative asset classes, including land lease communities, childcare, and agriculture, are benefiting from positive long-term structural demand themes. They have sought after government and institutional-backed income streams. This is attracting ongoing international and domestic capital to these asset classes. Fund management platforms are benefiting from continued search for yield and relatively attractive merits of Australian real estate. We expect that trend to continue. Turning to the US, some of the themes that are resonating with our team includes industrial logistics, retail malls, shopping centres, and storage, to name a few. Retail shopping centres in the US are benefiting from resilient non-discretionary spending, now the type you'd see in supermarkets and pharmacies. We also like A-quality mall REITs with superior balance sheets where valuations are attractive. And growth is actually accelerating from 2020 lows. An appealing alternative asset class our team likes is the storage sector. This sector is offering resilient and attractive long-term growth attributes, supported by accelerating demand and rising rental rates. At CBRE, we benefit from being part of a global real assets investment specialist. For example, our US team's fundamental knowledge and investment experiences in the land lease community sector, which is a far more mature institutional asset class in the US versus Australia, has helped us locally better appreciate the attractive investment attributes of the sector. This is only just emerging in Australia, with groups like Ingenia, Lifestyle Communities and Stocklands entering land lease communities sector.
Given the ongoing debate about the rise in inflation, is real estate an actual inflation hedge, given, I guess, many rental agreements include inflation or CPI in annual rent increases? So it strikes me that it can provide some inflation protection.
It is, Paul. Real estate stocks are an inflation protection sector, unlike bonds. Income streams grow. Many lease structures have built-in CPI bumps, while other sectors have short duration leases that reprice in the short term, depending on market conditions. Over the past 20 years, AREITs have generated over 4% outperformance relative to broader Australian equities during periods of above average inflation expectations. Albeit, it's fair to say in the short term, the sector can underperform when inflation rises quickly and bonds sell off sharply.
So, with interest rates at historic lows, I guess prudent gearing to me makes sense. So, can you provide the listeners with some insights into the level of gearing across the AREIT sector?
Today, gearing is 24% across the sector. This was 27% a year ago. For context, prior to GFC, gearing sat around 40%. Unlike during the GFC, in the COVID recession, real estate companies' balance sheets performed very, very well and are in good shape. Speculative activity appears in check. Today, the sector has much longer dated debt and more diversified debt sources. In the GFC, it was mostly bank debt with short-dated or lumpy expiries. Importantly, during the COVID recession, public companies maintained continuous access to both debt and equity markets.
And maybe finally, then, Justin, to the last question. Many investors allocate to AREITs in their diversified portfolios to provide a reliable source of income and for the potential for some capital growth, and hence need to consider whether they're going to employ an active or a passive strategy to provide this exposure in their portfolios. As 2020 was a highly volatile year for equity markets, it is a good opportunity, I think, to assess active managers' performance and test the merits of active management. So, how did your fund perform over recent years, and including 2020? And what do you think CBRE's, I guess, keen point of difference as an active manager is?
Our fund delivered almost 14% per annum on a rolling 3-year basis, and that's after fees, and has added more than 4% or 400 basis points of annualized performance over the benchmark in that period. In the 2020 calendar year, the fund was broadly flat and outperformed the benchmark by around about 4%. Importantly, in 2020, the fund outperformed through the volatility in both strong up and strong down markets. Active management meant you weren't a total passenger through the market ups and downs of 2020. There are substantial opportunities for active AREIT managers to add value over a passive AREIT index fund due to potential for significant alpha generation in the AREIT sector. Wide stock and sector dispersions, as we saw in 2020, increase the opportunity to drive alpha through active management. Expectations for increased M&A, for example, allow an active manager to overweight opportunities, whereas passive strategies are at best a market weight. The AREIT index has typically had a high weighting of over 50% to traditional real estate, such as retail and office asset classes, providing active managers an ability to over-allocate, to preferred themes such as highly sought-after alternative and emerging sectors. Our fund's performance has benefited immensely from active exposure to long-dated, positive structural trends while avoiding those areas with structural headwinds. Emerging asset classes like land lease communities, childcare, health, and agriculture, for example. Many of these themes are underrepresented in the AREIT index. As a manager, we believe the fundamentals we observe in the direct real estate market ultimately drives performance of public real estate stocks over the medium to long term. Our key point of difference, and one of the reasons why you would choose CBRE, is our information advantage, our connection to the CBRE Group resources, systematic and repeatable investment process. We're a uniquely positioned investment manager within CBRE Group, specialising in listed real assets. Our information advantage is our ability to leverage CBRE's extensive direct real estate network of brokers, researchers, property managers, appraisers, consultants, and lenders to draw unique and timely insights, ultimately harnessing the extensive data and market insights to drive better stock and portfolio decisions, resulting in better investment outcomes. We believe our proprietary information advantage and extensive data resources ultimately supports our systematic process and provides us an ability to consistently deliver excess returns to our clients.
Justin, it's been an interesting discussion, and particularly hearing your insights into the AREIT property market and some of the challenges, I guess, and the volatility we've experienced over the last 18 months, but also, I guess, some of the resilience of the sector and the subsectors, some of the growth opportunities that you've highlighted in talking through, I guess, your views on industrial and office and retail and diversified, and I guess the alternative properties asset class, including like healthcare and aged care there. So I'd just like to thank you very much for joining us this morning on the Portfolio Construction podcast series. So thanking you, Justin, for your time and your insights.
Thank you, Paul, and to Netwealth for the opportunity to speak with you today. It's been very much appreciated.
No, it's been an enjoyable discussion hearing your insights there, as I've mentioned there, and I guess the broader views of the CBRE Investment Management business there. And to the listeners, thank you for joining us again this morning on the podcast series. I do hope you're having an enjoyable week, given spring's now on us. The weather's certainly providing a more positive outlook for us all as we get up of a morning. But wishing you all the best, and I look forward to the next instalment of the Portfolio Construction podcast series.
Thanks for listening to this episode of the NetWealth Portfolio Construction podcast series. For more episodes and to subscribe to our series, visit our website www.netwealth.com.au or visit the iTunes Store or Spotify. We hope you can tune into our next episode.